You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are delighted to be back with the last edition of this year of the Systematic Investor Series, which is our weekly open-ended and pretty raw exploration of the world of rule-based investing, and where we also take some of your questions. So good morning, Jerry, and good afternoon to you, Moritz.
Hello, Niels. How are you?
Good morning.
Good morning, Jerry. I'm well, Moritz, and of course we missed you last week. You were out on the slopes. I hope you had some good skiing conditions.
Yes, had a great time. Really like skiing. Good snow, sunny weather. So it's been a great break. It always feels good to, be a bit away from the markets and the daily action, and then come back with a fresher mind.
Absolutely. And so while most of us were enjoying all the festive season, U.S. stock markets joined, at least for a short period of time, many of the other stock markets already in a bear market, but it seems like only a few phone calls from the U.S. Treasury brought out the sort of the plunge protection team this week, and that certainly led to some fireworks being lit after the Christmas holiday. So quite a week to sort of finish the year on, and it'll be interesting to review how all of that impacted sort of the trend following space that we belong to. So why don't we just jump into it and find out how it all played out, Moritz? If now that you are back, if I can go back to our usual tradition to start off with you and see what the week was like through your rule-based eyes, so to speak.
Fireworks indeed. I mean, the last 2 days, they have been really wild in terms of equities and how they moved, starting lower and then reversing and, ending the day higher. So a lot of range covered within a day. But, looking back, December has, despite all the vol that we've seen, December has been a pretty good month for me. Between 4 and 5% up as of right now. The year, although, is still down about -3, -4 in my case. But, the past couple of days, the good trades were short the Aussie dollars, short the Canadian dollar, short the equities, short oil, and long the bonds. Actually got longer in some of the bonds, especially in the US and in JGBs. So that was all good. Some of the bad performance, natural gas. I mean, we all had that breakout. I think we all got long. Natural gas has been moving lower. Still have that long position on, so that hurt. Still have a short gold position, also short silver position, which costs some money because the precious metals, they've been rallying in the past couple of days and weeks. And the same is true for the Swiss franc, which is a safe haven currency. So that one appreciated, and I was short that. But overall, can't complain about December.
No, doesn't sound like it. Of course, it's interesting, Jerry, since you're the only one of the three of us who trade the single stocks. And when something, quote unquote, as dramatic as this week happens, especially when we see, clear manipulation again by authorities in the markets, how does that all play out, through the lens of single stocks?
Well, as you'd expect, a lot less dramatic action. They're not all moving in the same way. So better to be short the indexes, except when they rally 1,000 points. So it's more of a diversified group. Some continue to go up, some went down, but just less dramatic, extreme performance in the stock sector overall.
Yeah. And what about other things going on this week from your perspective? Anything exciting or more of the same that we had already seen earlier in the month?
Well, it does seem the trends are back, and interest rates are going lower. So that play out with the Fed will be interesting. CTAs are long bonds and have been for a while, and the U.S. is now going along with that. So that's beneficial for our investors. I do think there's no reason to be concerned or worry too much about these rallies or the S&P, the Dow being down 600, then rallying plus 250. This is things to ignore. You're short with a big profit in your indexes, so be happy and ignore the crazy fluctuations. It's one of the benefits we have of being trend followers and having a trailing stop and maybe even being long-term trend followers is everything that happens above that exit line, that breakout line, or that moving average crossover line, you can just absolutely ignore. And so it's best when you're making money in December to look at the quotes and the charts as infrequently as possible.
Yeah, no, absolutely. And I think, I'll concur with Moritz. I mean, those were some of the same market movements that we benefited from this week. Also, a positive month for sure, even though the year has been a tricky one. And I think it's interesting. Let's put things in perspective. I mean, we started this exploration about 4 months ago. And of course, the last 4 months, as has most of this year, except for January, it's been pretty difficult for our industry and being a trend follower. And I think also when you look at broader indices of other types of hedge fund strategy, has been a difficult year. Yet when you look at these drawdowns that we are all sort of still sitting on, but you look at them in relative or in relation to the analyzed volatility that our strategies represent, and then you compare that to the drawdown of, say, at least 20% or more in some of these US equity markets with a much, much lower volatility, then the drawdowns from trend followers and other strategies in our space, they don't really, in my mind, look so scary. What seems, and it goes back to this thing that, you mentioned a lot, Jerry, in the past, and that is, we're being compared to an 8% strategy that is allowed to have a 50+% drawdown from time to time. So when you look at volatility adjusted drawdowns, actually trend followers in many respects actually don't look, as risky as these equity markets. And I think the fact that they managed to erase 2 years of profits with, in a few weeks, I think, again, it should be a reminder to investors that, if you want to own equities, that's fine, but you need something else to balance the risk, even though maybe the three of us would argue that you don't need anything other than trend following. But most investors, let's be real, will have more equities than they will have trend following, unfortunately, but that's just the way it is. So I think it's worth, taking a step back and just looking at these risks, because I've certainly met a lot of people during this year talking about, how risky what we do might look like compared to equities. And then they, pile even more money into equities. And then suddenly something like this happens. And it's a great reminder. The other thing that I wanted to just mention is, as Jerry says, trends are back. I mean, I was just looking right now at the trend barometer that I publish every day of 44 different markets, and 68% of those markets now, as we speak on this late December day, are in some kind of trending behavior. This is completely objectively speaking. It's not following a specific model per se, but just a state of momentum and trend is now being recognized in 68% of these markets. So trends are certainly back when you look at it from that perspective.
Which is great. And I remember, I think you mentioned the trend barometer a couple of weeks or maybe 2 months or 3 months back, and there was almost no markets in sustainable trends in any way, right? So that has changed, and it's good for us. And hopefully good for the next year.
Yeah, and also I think hopefully what's been useful for people listening to our conversations each week is that it's this thing about just continue what we do, follow the process, don't be, don't be, concerned about what's happening. Just like Jerry said, as long as you're above or below whatever way you're invested in with some of these strategies, and you have a stop loss or another way of another set of rules that will take you out at some point. I mean, when you have this tool set with you on your investment journey, there really isn't any reason to be as concerned as someone who shows up every morning and actually have no clue or no guideline to how they should be investing. And even though the losses this year have been real and painful, it still gives us a tremendous amount of calm, I think, knowing that this is part of the path we take, and the path has never been a straight line up, and it never will be. But it's the path is big enough for us to stay the course, because we have the discipline to follow these rules. So interesting year indeed.
I agree, and it's a great reminder that things in the equities, they can change so quickly, right? Remember, we spoke about the Red October, which was a bad month for all of us. Then came November, kind of like flattish. Now December is up. So looking back at my trend following portfolio, which is diverse, which is long and short, it doesn't give me a headache at all. Very happy with that. Whereas if I were just long equities, long only, and then the last 3 months, I think that's very, very painful to see your money go down that fast, minus 20% in just a couple of weeks. It's really bad.
Yeah. You're so quiet, Jerry. Are you just absorbing our wisdom here? Or?
Well, I just think that we have to remind ourselves frequently that it's not a good risk-adjusted way to trade stocks only. That's not what we want to do. No one should be doing that. We should. We get a little uptight when we get beat by the stocks for such a long period of time. But it's predictable that if we were trading currencies only, commodities only, it would have the same problem. Stock only, and maybe if you don't even do shorts, wow, that's really not a safe way to approach these markets. And one can use trend following on stocks or commodities, but it's always going to be better to combine all the great markets, long and short, with the inherent risk management and that trend following brings. And we're going to be frequently reminded. And then the big question: how closer are we to having a lot of other people agree with us? So probably not that close at this point.
We're working on it. Jerry, I would also be interested in hearing a little bit about sort of the tweets that attracted most love this week in the social media space. Of course, it was Christmas, so maybe social media took a bit of a break. I don't know. Maybe people spend more time on social media because they had some time off from work. Who knows? But what was the sort of the themes that caught people's attention and your attention during the past week?
We talked about it before we started today about this one tweet that I retweeted. Basically, it's the focus that everyone has on long stocks and stock only and long only. And this one person was reminding us all that in the red for longs means in the green for shorts. Short is not a dirty word. As a strategy, it exists for a reason. And I chimed in saying commodities and currencies are not dirty words either, long and short, long or short. So I think that maybe it's hard for people to get short or trade commodities, and that's probably why they should have a lot of CTAs in the portfolio. But it is kind of irritating for me to have to live in a world that sees all investments through one lens, which is mostly stocks, maybe a few bonds and real estate, but certainly long only. And at the same time, a lot of the articles being written by people who absolutely agree that there's lots of evidence that trend and momentum and commodities and currencies and CTA portfolios are great and are good additions, but it kind of gets ignored when, it looks like it shouldn't be.
No, and I mean this week. I mean, if rumor is correct that this plunge protection team came out in force to prop up the markets the way it did. I mean, I think it's just another indication of how biases, are expressed in the world today. I mean, it's almost like politicians and central banks, they kind of have declared that we can't have another recession. That's just not something we want anymore. So we're going to do whatever we can every time we near a recession. And it seems like now we can't really have another bear market until the authorities come out and say, oh no, a bear market, we can't have that. So let's just jump in and prop up the markets. I mean, it's a very, very artificial managed world we live in, if that's the case. But of course, it also forms, and that's how investors are being influenced. As you say, if people think about these things as being dirty words, recession, bear market, shorts, currencies, commodities, etc. I mean, it shows you what we're up against. The three of us talking about something that we love and we think that makes a lot of sense to investors. Yet most of the media in the world, are dead against it.
Yeah, I remember in the early 90s starting my firm, and of course wanting to add more markets to the portfolio, and some of those markets were the currency cross rates, sterling mark, Paris mark, and all of the European crosses. And then someone at a bank told me, well, you shouldn't bother trading some of those because they're kind of pegged and there won't be any trends there. And I was like, oh, no. I want to trade them because of that. So I do think that we do get frustrated by some of these policies, but they'll eventually fail and break, and the market will have its way.
Yeah. Well, let's get, we can certainly remind ourselves what happened about 4 years ago in January, I think it was, when the Swiss Central Bank gave up its peg, and that certainly led to some trends, at least in the short term. So yeah, I agree with you completely. So what else took the liking of your Twitter followers this past week?
Well, as usual, I get a lot of interest from any time I quote Druckenmiller or David Harding. So those two were pretty interesting quotes that people liked from Druckenmiller. The inside of the stock market, which is the best economist I know and which I've used every cycle when I've invested, is saying there's something not right there. So my takeaway, and I think he kind of goes on to explain that when you're looking at indexes, you may be missing something in the market. And as I've said, we've been seeing for a long time, the different market sectors selling off and in sort of bear markets for months and months prior to the S&P being in a downtrend. So I think that's one of the fun things I get to look at is building a portfolio of diverse stocks and sort of seeing them behave differently in the same way that, platinum is down, palladium is up, energy was down, and then natural gas was up for a while. So it's just kind of fun seeing what's going on. And of course, I think we should all resist the market. What is the market doing? What is a bear market? Overlay your systematic approach to lots of different markets and sectors. And that's where the fun and the profit really can be made.
Yeah, that's true. You also mentioned David Harding. What was he out saying? I saw some headlines, but I didn't read all the articles, I must admit.
Yeah, his quote's pretty good. For 35 years, we have made money from trading momentum in markets. Quite extraordinary. The great and the good, are always on about fundamentals. In some way, we're slightly, morally suspicious for looking at numbers. Yeah, I'm not sure what the takeaway on that one is. Maybe my takeaway would be, people want the markets to make sense and the fundamentals and recession, and they just want to look at things in a certain way. And I think being able to reduce all of this to a profitable system that looks at trends and numbers just doesn't feel right. It's, boy, I wish the world would not work that way. But I think most of the people probably took away the idea that his statement that he's made money for 35 years, looking at momentum, which is, sort of great for us. We believe that. We're happy about that. And momentary problems, momentary drawdowns are certainly overwhelmed by the performance of the past 35 years for lots of traders.
Yeah, no, absolutely, and certainly worth always listening to what people like David Harding has to say. I think there was something else he came out with last week. I think there was a comment on AI and machine learning. I don't know whether you saw that, Moritz, on your side, but certainly when I had the pleasure of interviewing him for the podcast along with his co-founders of AHL, I did not get the sense that none of them actually, and including Harding, was none of them were really raving about artificial intelligence and how that might make our world more profitable. And I still think that it's interesting to just keep in mind that many of these rules that Jerry is trading, that we're trading, Moritz is trading, that some of these rules have really been in place for 40, 50 years, and you can't say that about many types of trading strategy, that they still work after such a long time. So yeah, I wonder what and also the whole point about AI is that maybe there's some advantage if you are a very, very frequent trader, short-term trader, high-frequency trader. But if you only do a couple of trades per market per year, I think it's questionable from the people that I've seen talk about their research into this, how much value it can add to trend following itself. But I don't know if that was what he was talking about on his, but I saw the comment about AI as well. Did you see that, Moritz? Did you read anything about it?
Yeah, I saw that. And, I think, at least I'm of the same opinion. I'm skeptical about the added value of AI systems. But as I've said before on that podcast, I'm also not smart enough to really figure them out. So I take the position of the distant observer and see what they come up with and what they deliver. Look at the track records that we can see. I think some of them are hidden from us, but some are observable. And to that date, those that I can look at, they haven't been that great. In fact, they've been doing worse than our trend following trading, or at least my trend following trading. Now, I'm also saying that is not a large sample size, so I can't judge based on that, and I need more data and more time to figure out what's going on there. But as David Harding, I'm skeptical. So let's see.
Yeah, absolutely.
And of course, I mean, many of those people may be pioneers now in the sense that they apply it while others don't, and I guess the majority of people don't yet, maybe. And so if there are pioneer gains to be had, then, well, all to them. That's the risk that they take, right? It's also there's new things coming up all the time, and oftentimes it seems that when there aren't that many people following them yet, applying them, then the potential for profits is greater. But like I said, I mean, we just need to see what's there.
Sure.
Well, certainly it's the opposite of trend following, which creates an approach that is to be used over all the different markets. Heck, in natural gas or in crude, the strategy that I use will have almost very little input from historical trades from crude or heating or natural gas. So it's looking in general that over a long period of time with a 40% success rate, is this going to get on board trends, and is it going to be able to stay on and not give too much back? And whereas AI is quite the opposite. Billions of pieces of data all ciphered through the computer, and it'll be able to tell us exactly what to do in this particular moment. And we're the world's worst at what's the right thing to do in this particular moment. We're like, oh, that's kind of random. Who knows what's the right metric, the right parameter will be on this particular trade, but applied over a long period of time, every single trade the same way, this has a tendency to make money. So it's not sure how to reconcile those two. I have no problem necessarily, having to come to the conclusion one of these days that trend following doesn't work any longer for many different reasons. That could be true. But I don't know if AI is going to, there'll be an industry like the CTA industry. I doubt that's the case, but it is quite the opposite of what we do.
Sure. So Harding was out in the news, and Druckenmiller. What else did you tweet about this week, Jerry? That got some reaction.
Well, it seems
good
that
or bad.
Yeah, it seems that not only the CTAs are kind of interested in this downtrend in stocks, but a lot of the commentators and writers about the stock market who usually write about how buy and hold and passive indexing is the way to go. They're very interested in this bear market continuing as well, it seems to me. And so there are lots of excuses and commentary being made this week about the big 1,000 point rally, and then Dow being down 600, I believe, and closing up 250 or something like that. And so, trying to understand, what is this telling us about the market? Should we be worried that we're going to have to get long soon? And so there's a lot of people trying to look at small sample sizes and sort of ensure themselves that, don't worry, the 1,000 point rally does not mean the bear market is over or the downtrend is over. And there was a tweet I kind of liked, which was, there are no rules for how the market bottoms. Stocks go down a lot, then they keep going down more until they stop going down, and then they go up.
Exactly right.
Sure.
I love that. And, yes, I'm sad to say that could absolutely, I'd be proud if that was my contribution to financial industry. No more, no less. That's a really good one. Then I finished by quoting, the charts tell a plain story, but they do not indicate the future. Truer words have never been spoken. I think I've said that in kind of different ways over the past, not nearly as good as that. But how can CTAs who do back test not fall in love with the past? And my answer has usually been the back test that produces thousands of trade sample size, entry, exit, stop loss, in lots of different markets, lots of different environments. These trade stats we want to rely upon them. We have 1,000 different trades, entry, exit. What's our average win, our average loss, our average profit, win-loss ratio, our winning percentage? These are rock solid. We get that from history, I guess. But the history of the markets and how they've behaved and is no guide for the future.
Yeah.
One of the things that I observed this the past week on Twitter, or the past 2 weeks, is that because of the drawdown in the equities, I saw a lot of commentary on, okay, this must be the low because we had a reversal day on high volume. And looking back in history, there have been 3 occasions or 4 occasions where something like that has happened before. And it's all like this, oh, really? Do you really want to make that point? And it's so, I had the feeling that probably a lot of people are really hurting from that drop in equities. And they were kind of like, soaking it all up with, if there's that information out there, that little piece saying that, oh, that has happened in 1987, or the only time it happened was in 1987, and then it went all back up from there. This is just so meaningless to me. And it's just like Jerry said, I mean, we have, our statistics, which are rock solid, but what the next week is going to do, we all don't know. Nobody knows what the next week is going to do in the markets. And it's also, again, this time of the year where you read a lot of forecasts for the next year, like people saying, oh, well, that, we have the January effect and pension funds need to rebalance their portfolios and they need to be buying equities. So therefore, definitely, get long now and, buy stocks because they'll be getting some tailwind in January. Well, yes, that has been maybe true in the past couple of years, but it doesn't mean that it's going to happen this year. and all those, like, there's lists come out with, those are the 10 things that we expect to happen in 2019, and credit to get worse and equities to get worse, and the recession is coming, and yada, yada, yada. I'm getting a bit tired of that, because really, people just accept that nobody knows that stuff. Really, nobody does.
I mean, that's,
and it's, probably taken all of us quite a while to accept that, and really not worry about that. Just, follow the price, look at the price, and, do what the market is telling us to do.
Well, there's also the famous Santa Claus rally, which certainly didn't really happen this year. So you're right. I mean, these are anecdotal, evidence that people have observed from time to time, but it doesn't mean it will happen every year. It doesn't mean it will happen,
Exactly. But I think people, they want to read that, or they like to read that. There's a lot of activity going on about that, and a lot of retweets and likes and stuff, where I think, well, why do people really, get so excited about that? To read a report published by, I think it was Deutsche Bank, with, those are the 10 things that are going to happen in 2019. And when you've looked at all their past reports, probably they've never been correct. I mean, that's all just guesswork.
It's definitely just trivial marketing, and I feel bad for people who waste a good college education on predicting the future. And we get lulled into thinking the Big Short. Why didn't I see that coming? God, those guys must be amazing. And so we're bombarded with it as well. Maybe we can do better. Some people can do better. One of our questions from George kind of hints at that. But I think, honestly, one of the things I think about very frequently is if you really, really believe, if we really, really believed, which I think that we might sometimes, in what we do, I mean, I think the only obvious conclusion is that following the price trends the way that we do it, not too long term, not too short term, lots of markets, multiple systems, you can't beat it. You cannot beat it. No one can beat it. The closer you are to the truth of how to set these systems up, not too many parameters, not too much over optimization. I'm not sure if I'm average or slightly above or below average in doing that, but I know that there's probably someone out there who has been doing it and been very consistent, and I doubt that you can really beat their track record. If we really believed in this, I think that's the only conclusion we can come to.
Well, I mean, I think one way of looking at that in terms of trying to find evidence for that statement is to say, okay, how many discretionary traders out there do we really have with a 30 or even a 40 plus, year track record? I'm not so sure that we have that many of them yet. We still have a number of people in the systematic space who are still around, still doing well, and delivering on that promise. And I think that this is the interesting thing about these things, that some of the things we talk about and that we truly believe in, there's a lot of evidence for those claims that we make. Yet there are so many people who don't want to look at the evidence objectively, and prefer, as Moritz was saying before, they prefer to invest based on someone's report about what's going to happen in the future, or someone coming on to the financial, or I should say the usual financial media outlets, and talk about how this stock is going to do this. And I mean, let's face it, 3 months ago, how many people came out and said, oh, I think Apple is going to go down by 30%. I didn't see any. So
So I mean, those are
just a funny thing.
The opinions, and like in Skin in the Game by Nassim Taleb, right? He says it. I mean, don't just follow anyone's opinion. Trust but verify. But insist that the person that gives a recommendation has that recommendation backed up with money, with a position. I'm paraphrasing here. That's not exactly how he said it, right? But it's so true. If somebody came to you and said, I'm short oil because of ABC reason, okay. And if that position, in his account statement, he is short oil, then I think, well, let's have that conversation, right? But somebody coming to you saying, I think oil is going to go down to 20 without a short oil position is, well, let's have a chat, but it doesn't really mean anything.
Absolutely. Anything else you want to add, Jerry, from the world of Twitter before we move on to maybe you mentioned George, so we have a few questions from George this week, I believe.
Yeah, let's go to George.
Okay. Good stuff. So here is one, which is there's a bit of a sort of background. So let me try and read this and see how it goes. So it says, in episode 14, Niels pointed out that you each had different performance at various points in December, which showed the difference within trend following. Examining returns on the CTA databases, I see differences in returns as well, which supports Niels's point. As if everyone was doing the same thing, returns would be identical by definition. I've noticed investors and traders have a tendency to do what I call grail seeking, which means looking for the best system and presumes that there is one best system out there somewhere, the holy grail system. However, per above, if there are, hang on, let me say that again. However, per above, if there was one best way to do things, everyone would be doing it in the same way, since they would all arrive at the best system eventually. Obviously, they aren't. The conclusion is, if there is no right way to follow trends, there is no right way to follow trends, there certainly seem to be commonalities in all trend following approaches. Trade with a trend, ride winners, cut losers, manage risk, use stops, but the details are all different. You've touched on this in different ways before in the podcast. Early on, you explained the specific metrics you, Jerry, use to qualify a system. That said, I'd love to hear, and here comes the question. That said, I'd love to hear a more in-depth discussion on how this on this specifically. I think it would be helpful for all listeners to understand nuances within the discipline to establish reasonable expectations. Okay, thank you, George, for this first question. So, Jerry, since you received the question, do you want to venture into this first and talk a little bit about sort of what you think of when you think of different ways of doing trend following?
Yeah, I do think that the correlations can be sort of highish, and we have similar performance a lot of the time. So maybe we are doing things more similar, and some of our differences don't really matter that much over a 6-month or a year span. I'm usually not a fan of this sort of idea that humans like to trot out there, which is there's many different ways to blah, blah, blah. Well, I guess there are many different ways, and there's many different ways to kind of be sort of successful. But maybe by definition, is there one best way? I mean, not that we're ever going to get there. I'm certainly not saying that I have the best way, but I do think it's something to shoot for, that there are better ways, best ways. There are mistakes that I think we all make, that if we all got together as one big cartel, I think we'd all come up with a much better system. What do you have, Niels? What do you have, Moritz? What do I have? What does Harding have? I think, it would be better if we all sort of combined. So I wouldn't give up on, I don't think Holy Grail is the way to go about it, but I do think that I've been very opinionated on some of my ideas, and so I think they matter. And I think if you're not doing some of my ideas, you should. You should do better. And God knows I have had to correct and improve and recognize some of the mistakes that I made over the years. So you can always get better, and there's some fundamental facts. I think you should trade all the markets and go short. But I think there's more smaller things or things that'll matter a little bit less, but they're still worth doing. AQR wrote a paper this year, and I think it's called something like the craftsman's approach, something like that. It's about a craft, and these small things that I add, or we all add to our systems, where we say, wow, I should have been doing this for 20 years. I've made a little mistake here, and I'm going to make my system a little bit better, more solid. I think these things add up over time. The one problem is the goodness of them are not shown on a daily basis or weekly basis or monthly basis. So that's sort of one of the problems. So I full speed ahead on making things better, and you can and you should, but Holy Grail is probably not the way to look at it.
Absolutely. What about you, Moritz? What are your thoughts?
Yeah, I do have a couple of thoughts on that. I don't think it is a good pursuit to find the Holy Grail system, because I don't think it exists. There is no the best system for everyone out there. The important thing for me is, and I think it should be for everyone, is to find the system that best fits you, the system that you can follow, the system that suits you, the system that you believe in, the system that you've researched to such an extent that you know exactly how it works, what to expect from it, and that you love and like so much that you're not going to tinker with it every time it has a loss. So, when I, just as an anecdote, when I looked at, the way my system developed, I, tried out different things. I worked with moving averages, I worked with crossovers, I worked with breakouts, I worked with regression lines, and, all those type of things. And as Jerry was saying, over longer periods of time, the correlation between them is sort of highish. But in my case, I ended up with a breakout based system because there were certain things in the way that works. And that hasn't been driven, by the way, by historical performance. I didn't go down and say, well, I'm choosing the breakouts because the breakouts, they've produced better performance in this year and better performance in this year compared to, say, the crossovers or something like that. That hasn't been the decision-making process. There are certain things about a breakout-based system which, in the way that I've designed it, I like more than in a crossover type system, even though those systems are great also, right? But I think what I like best is the fact that it can keep me out of positions for a while longer. So I have more like, there are certain markets which I kind of like, I'm flat in, if you will, because I haven't seen a breakout to the upside or to the downside, and I've been stopped out prior, so there's just no position. Whereas depending on how you design an average based system, it kind of like gets you long or short, and you have a position all the time. And that was kind of like, I like that. I really like that, and I went for that. And that suits me. That suits my personality. That's the way I want to think about this. That's the way I want my system to work. And that's why I can follow it. That's why it's the best system for me. And of course, I'm working on making it better and finding little pockets here and there where, after very thoughtful research and lots of time passes between implementing those changes, like, thinking and mulling over them over and over again. But if it does make sense, yes, build them in and try to improve your system. But this is my Holy Grail system, which is developing, changing, hopefully getting better. I'm thinking about things. We're all developing, we're gaining experiences. So that's kind of like, it never stops. But I don't think my system is the Holy Grail system for anybody else.
Yeah. No, I think from my perspective, George, I think that in addition to what has already been said, I think what you're hinting at in terms of other small nuances, and of course there are. We make choices about time frame. And if you had listened to, and I'm sure you may have, if you listened to some of the previous episodes, we talked about a study that we did on our side, just about, what's the optimal look back period year by year, calendar year by year. And it's hugely different. You can have a period of time where they're kind of the same, but you can also have years where they're really different. And so we have to make choices. We have to decide where in that spectrum do we want to be. And some people have predefined look back periods. We do it a little bit differently on our side. We at least allow the model to gravitate towards longer or medium term periods over time. So, but for sure, I mean, we're never going to get it right. So we just want to stay in sort of the middle section of these extremes. So that's one choice we can make, one nuance where I'm sure Moritz, Jerry, and I, or Don is a little bit different. And then, of course, the markets we decide to trade. I mean, I think we all truly believe in diversification, and we all love having the commodities in there, but there can still be differences between which market specifically we include in the portfolio, even though I think the three of us are probably pretty similar. But then there is, the choice that Jerry made about single stocks, which is not something we've adopted. I don't think Moritz has as well. So those are the nuances, but those small nuances can make a big difference in performance. So, and I think that's what we're seeing this year, that some of these small differences actually have produced quite a big range in terms of performance among quote unquote trend followers. But great question. But I think the takeaway from here is that none of us are looking for the holy grail. We're not trying to have the best system, and we all know that we haven't. But the systems we do have are good enough to produce the kind of returns with the level of risk that we're comfortable with, and that our clients, more importantly, are comfortable with. But George didn't stop there.
Yeah,
Go ahead, Jerry.
Make a comment. Over a short period of time, or a year or two, I think these small differences, they do look rather large when you look at the performance, good or bad. So I think that's a very good point. And I was trying to disagree with Moritz a little bit, thinking about how can I disagree with that, because I really don't like the idea that I should trade something that I like, my personality. It's good for me. I guess that's a thing I have usually tried to stay away from. What's good for me is 1 or 2% per month, and every month. And so what I do is not good for me. I don't really enjoy it as much. And what I figured out about trading is it's difficult. It's hard. Giving up all the profit in natural gas. In a systematic approach, following your system is the bottom line. And part of that following your system may give up big profits or medium-sized profits, nice profits that you wanted to keep. So, but I do think maybe a better way to state it would be that rather than disagreeing, I think that it's not so much, I think that what I said is true, but I also think that we get these choices of what's important to us. From a math point of view, what's important? Is it important for me to have a good Sharpe ratio? Is it important to me to have a good return divided by drawdown? Is it important for me to make money frequently every year, or increase the chances that I'll be profitable every 12 months, and things like that? And these definitely are the choices and preferences we make, because we all look at these numbers and we say, okay, great, but I would never accept a drawdown like Jerry would accept. So I can't trade that system intellectually or emotionally. I'm just not going to go there. So I think that's a good way of looking at it, that we do make these choices based upon our personality and our intelligence, what we think is important to us and our clients. But I still think that don't seek out ease, comfort, and pleasure and something that's going to fit your personality. What works in the markets, taking small losses and going with the trend and being willing to follow a system even when it's losing, is probably not suited for many of our personalities.
Yeah, I agree with that. Still like my system. I like, it's sometimes very painful to follow that system and hurts and it's uncomfortable and difficult, but still I have to like that system, and I do.
Good stuff. Well, there is definitely more questions from George. George goes on and talk a little bit about sort of global macro. And of course, we need to distinguish a little bit between global macro and systematic global macro, which a lot of people think of is very similar to trend following in some way. And George makes an observation that global macro seem to have done better than trend following, and he asks. Well, he concludes, and I'll read this last bit of the question. He says, this implies there might be an edge in adding the macro approach. I know where you all stand on trend following versus macro, but was hoping you three could discuss why you think the macros have experienced better returns. Luck, skill, good timing, informational advantages, human skill, human still adding something that can't be quantified. Let me take a stab at this first, George, and just say you're absolutely right. I mean, if we are not talking about systematic global macro, but just talk about global macro managers, you're right that there are differences that can come out as a advantage, and one of them being that you can anticipate something that our systems can't do. And of course, if you're really, really good at it, I don't think any of us would suggest that can't add value. I think what we all would agree on, though, is that it's not something we believe is sustainable. You can be lucky and it can work for a while, but for 20, 30, 40 years, it's unlikely. And as I said earlier in this conversation, when we discussed another topic, how many discretionary traders, which global macro would fall into, I think in most cases, are still around after 20, 30, 40 years, not many. And I think it's, and I don't even know what the global macro performance index is this year compared to the trend following index. So in the last few years. So I'm talking about, from a little bit of a non-informed background here, but I just don't think necessarily one can make the conclusion that macro is better. It's different. And if you have a large portfolio, which you may well do, George, in your work, it may make a lot of sense to add different strategies together. So that would be some of my comments about macro versus trend following. What do you guys think about this topic?
Great topic. I love it. Great question. I definitely don't know how he worded the last option, but I definitely think that humans adding something to the system that can't be quantified. Ooh, no, zero chance of that. But there's one big, huge monster, obvious answer to this question, which I'll try to delay and try to figure out, can I come up with something that might be, I think one thing I would say is that maybe these guys are a little bit smarter than some of your CTAs, and they have been secretly trend following. They have lots of wealth and assets, and they can certainly create a little secret trend following in their programs and not go around talking about it and scaring people that the computers are in charge. And I think the famous macro guys certainly adopt some of the elements of trend following, taking small losses and paying attention to trend, respecting a breakout. Maybe their opinion was short, but the market breaks out to new highs. I'm pretty sure that it's difficult to survive in this field, not paying attention to the price and taking small losses. But obviously, I think the big issue is just for whatever, for the obvious reasons, they overweighted the best trending markets of the past 20 or 30 years, unlike the CTAs. So being long stocks, the majority of your portfolio being in that particular sector is going to really, really improve performance.
Yeah, absolutely. What are your thoughts, Moritz?
I agree. Well, one of the things I thought when reading this is that I have to go back to the databases and look at the actual numbers, because I must admit I haven't looked at the macro numbers in detail in a while. And like you said, Niels, maybe there aren't that many track records available that are longer than 30 years or something like that. So I want to have a look at that. But one thing that I'll add is that certainly some of the macro managers, they maybe they use momentum as an underlying theme, but they will also trade different instruments. So not just the futures or the single stocks, but other OTC contracts, options, things like that. Maybe they go more into corporate bonds and credit and emerging markets. So all of that, of course, will alter the return profile. And if they're good at that, that may give them an advantage. But like I said, I want to go back and have a look at the numbers, and then next week when we speak again, I may have a better answer to that.
Sure. No, that's perfectly fine. George continues with another question. He refers back to episode 10, about 22 minutes into our conversation. You, and that means you, Jerry, state your research shows returns tend to be half of drawdown. So if you have a 10% return, expect a 20% drawdown. I think that George is just talking, or maybe asking us in general a little bit, if that's what we tend to find the profile is. And then he goes on to quote some of his own findings from some of the books and resources that he has studied, and looked at some of the well-known names from the 70s and the 80s. And I think he's also asking a little bit about whether we believe that some of the golden periods from the 70s will come back. So, Moritz, why don't you add a little bit about your thoughts on these topics, if you wouldn't mind?
Sure. Even though I can speak about the golden period of the 70s.
You were not born.
That's right.
That's true.
But yes, I mean, I think the statistics, or the ratio that he mentions between the return and the drawdown, yes, I've seen that. I've seen that in other track records also. The other ratio that I see repeating itself is that one should expect about 2 to 2.5 times vol as a drawdown. So if you're trading 15 vol, then you should expect between 30 and 40% drawdown at a certain point in time. And that also seems to be a part of the historical track records when you look at them. Now, the other thing that's very interesting about in his question is, of course, in the earlier years with markets, less markets available to trade, but also less participants, no electronic trading, has been a better environment for trend following strategies, less crowded, those type of things. My hunch is yes, probably was a better environment for that, but regardless of that, even today is a good environment. We have now more markets to trade. We can diversify the portfolio even more opportunities to work with. So, these, what can I say? I mean, tough to look back. I would say that yes, the more people trade in a certain style, the more difficult it gets for everyone to make money out of that.
Yeah. I mean, I would concur with you, Moritz, in terms of the losses. I've got another rule of thumb, which I think is pretty similar to what Moritz was saying, and that is, if you take the monthly standard deviation of a track record, and you times that by 5 or 6 times the monthly standard deviation, is definitely a drawdown that you should expect at some point from a manager. I think it's pretty similar to what Moritz was saying, and it obviously is a lot easier to calculate it if you only have to take the yearly volatility and times it by 2.5. So stick with that. That seems to be a good one. And will the golden years come back? I mean, actually 2008, which is not that long ago, and 2014, which was only a few years ago, was pretty spectacular, even in the long term perspective. So do these years, will they come back, these periods? Of course they will. When, we have no idea, but I think it's one should never rule out. And again, it goes back to this thing about, as an industry, we don't know what's going to happen in the future. So of course we don't know if these golden periods, when and if they will come back. But it's my belief that markets will continue to move and they'll continue to surprise us, and therefore there's no reason why we shouldn't see some very strong performance periods in the future.
I agree with that.
Yeah. Jerry, anything to add to this? This was the last question from George from this time, and then we have one more question which we should talk about.
Yeah, I think the drawdown. I think the proliferation of trend followers or trend people paying attention to a trend does make things a little more volatile. We've certainly, I believe in response to too many trend followers, too many computers, we've become longer term. There's a lot more noise, let's say. There is a famous quote out there that David Drews, he said, I think something along the lines of, a trader is following his system, or that he has a robust system if he has big drawdowns. So I think there's some wisdom there. Can't take it to an extreme, but I think what he's trying to say is, if you don't have these big drawdowns, if you're running a trend following systematic approach that has a chance of making money, or at least the back test looks pretty good, and you're not experiencing these drawdowns and these metrics that Moritz and Niels and Jerry are talking about, you may have a problem with your system, or you're God's gift to trend following all of a sudden. Kind of doubt that, right? So if you have bad ideas, take profits, excessive vol targeting, then yes, over a short period of time, maybe you will have a Sharpe of 1, but you may have issues down the road. So take comfort in the fact that, hey, we're kind of all in this together. We're kind of seeing the same numbers. Doesn't mean you can't improve and be the best, but tremendously great Sharpe ratios and low drawdowns in relation to your targeted return may be a sign that you have a problem.
Yeah, no, exactly. And David Drews did in fact say this thing about that, the more volatile your system is, the more robust it is, because it's been through all of these extremes.
And another thing I'd say is that maybe I wasn't, I think I left this part out. And that is, I think another thing he's saying is, in order to get to make the drawdown smaller, it's pretty easy to do. You just have to override the system. So if you're not overriding the system and you're waiting for things to work out, passively following this system, that yes, it will make money, but it will have big drawdowns. Then you're going to have these drawdowns. You're not going to interject into the system risk control, quote unquote risk control. I get frustrated because it's like, if you call it risk control, then you can do it. I used to sit in front of a quote machine and get out of trades quickly. I used to reduce my positions because I was losing money, or I got emotional. Well, if I had known all I had to do was just call it risk management, then I'm off the hook. I called it a lack of discipline or not following the system. But it's like today, oh my God. And then number 2, if you just program it in, well, who can argue with programming it in? It's part of the system. How can you argue with that? Well, I'm arguing against it right now. Don't be heavy-handed in preventing these drawdowns, because in essence, all it is just discretion.
Great stuff. Thanks so much, George, for all of your insights and questions and all of that. Let's finish off with one last question from Liew. I think hope that's the way you pronounce your name. He has a specific question, and it's really specific to you guys, because I think you use this kind of methodology in your systems, and since we don't, so it's probably better for you guys to so he talks about a specific sort of example. He says, let's say I'm long a futures contract and I put on a stop loss on it. after 2 days, the trade goes in my direction. I want to have a trailing stop upwards based on ATR. So my question is, does the trailing stop loss calculate from the highest price less the ATR? I have this question because my broker has trailing stop indicator, which uses lowest price less ATR. I read from books stated highest price to use. So which should I use is the question. Highest price or lowest price? Have you guys any insights that you can share to help out Liew on this particular point?
Well, I would just say that we've tested this and looked into trailing, and a lot of people I think do use ATR trailing stops. But it's a good question because the answer to all of these questions is the same pretty much, and that is it doesn't really matter. Lowest price, highest price, closing price would probably be the one I would have guessed would be the most obvious, minus the ATR.
Yeah.
How many days do you use the ATR for? If it's a short-term ATR, it can expand. So your trailing stop actually can become lower, assuming that you're long. Do you say, no, it can't become lower? All of these are, probably have some trade-offs, and they're probably all about the same. So choose the one that you think is the most robust and don't change. Stick to it. Don't go back and forth. Don't zig and zag. Be consistent. I think that's what is the answer.
Sure. Makes sense. Moritz, anything to add to
I use closing price,
okay,
which is the one he omitted. But as Jerry said, I mean, that's a matter of choice and taste. I use the closing price because at the close or at the time of settlement of that futures contract, you have a concentration of volume. So you may think that maybe that is a meaningful price that the market wants to trade at because a lot of volume is transacted. So I'm using that. Whereas if you look at the high or the low, then those can also be meaningful, but maybe there's not that much volume there. But as Jerry said, I think at the end of the day, it really doesn't matter that much. The more important decisions there are, if you're using an ATR-based stop or an ATR-based trading stop, is what calculation window are you using for your ATR? Is that 20 days, 50 days, X days? You need to find a number that you can work with, that you're comfortable with, and will you allow that stop to become lower than your lower over time, as Jerry was alluding to. If you have an expansion of ATR, will that result in your stop becoming lower, which increases your risk? Those are questions that you have to answer.
Absolutely. I like those thoughts. Thanks both of you very much for that. Now, while you ponder on what our closing topics should be for this episode, the last one of 2018, let me just remind people a little bit about performance so far this month. And of course, it's a holiday week, but I think these numbers are updated as of the end of Thursday evening. So again, Friday is not part of this data, but the BTOP 50 index was up 1.23% for the month, down 4.08 for the year. SocGen CTA index up 1.85% for the month of December, down 5.46 for the year. SocGen trend up 1.65 for the month and down 7.47 for the year. SocGen short-term traders index up 1.79 for the month, and that meant that it's back in the black now for the year, up 0.26. And finally, the Bridge Alternatives, the flat fee index, up 2.45 for the month and down 7.65 for the year. So, gentlemen, we're coming to the end of this episode and the end of 2018. I think we should do next week. Maybe we should do kind of a year in review and look at how market sectors that stood out in each of our portfolios. That could be a good good theme maybe and useful for our listeners. But anything that you want to bring up as we close down 2018?
Happy New Year. Happy trading. And looking forward to continuing that conversation, and happy to do the year in review next week.
Yeah, well, welcome back, Moritz. We missed you, and it was a lot lighter load this week for the two of us, so we appreciate that. You're still going to get paid for your week off from this wonderful podcast. Yeah, I think keep challenging us. The questions are great, and don't believe everything we say, and maybe we'll learn something from you guys. But stay strong and take small losses, and be bold with your profits. Don't worry about small rallies against these great shorts.
Absolutely. It's it's been a interesting time to launch this series, hasn't it? Because it's been kind of 4 months of a very challenging period, but also ending maybe a little bit on a high note for this strategy compared to the traditional market. So as Jerry and Moritz concluded with their remarks, I mean, the questions are very much what makes up this series, and we really enjoy answering them and being challenged, as Jerry said. And we certainly are really grateful for those of you who have gone to iTunes and left a rating and review. It is tremendous how much it helps us because more people will discover the podcast. So if we have one wish as a collective group at the end of this year, it would be for you to continue to do that. It's a great help for us, and we very much look forward to being back next week with our year in review episode of 2018, and also I think next year you'll find that we'll bring in some hopefully some really interesting people on occasion to come and join this conversation. So and if you have any ideas for who that should be, and if you have any access to some really interesting people, by all means, do let us know. You're more than welcome to tweet us, or you can write us at info@toptradersunplugged.com, and we will try and deliver on those suggestions. So from Jerry, Moritz, and me, thanks ever so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.